MBA ASAP. MBA ASAP.
So we'll take a deeper dive into the world of accounting, and we'll talk about bookkeeping. So, like we said, there's two parts of accounting. Bless you. One part is the financial statements, and that's the end product of accounting, and the other part is bookkeeping, and that's actually making all the entries and things. So, it's the keeping of the records. It's all of the taking them from the invoices and the receipts and generating those kind of invoices to different customers, every transaction, and putting those into some sort of a accounting system. QuickBooks is like the one that everybody uses these days. But it used to be that everybody would use journal books, and actually write them in by hand and then add them up, and think about that before there was calculators even. You had to actually be able to do the math and really understand if the debits you were doing and the credits were right. Now, a lot of times you can almost fake it because you can go into QuickBooks and say, okay, the debits are this and the credits are that. And then if it doesn't balance, then you just flip them and then it balances, and then you headed backwards because you don't have to necessarily know how all those transactions happen. But the way it happens is you get those transactions, you figure out what the transaction's going to be, what accounts it's going to impact, and then you put it into that ledger, and then all of those aggregate up and then make the financial statements at the end of the time. We're right now in the quarter just ended, the third quarter for a lot of companies, so September 30th. So they're busily putting together their third quarter financials in most cases. For public companies, they get 45 days to do a quarterly, what they call 10Q. And so by November 15th, they'll all have to have them out. But now we're getting into what they call the reporting season, where all the companies start to have their investor calls and tell them how they did in this quarter and all. One of the big companies that has an impact on right now is Tesla. Because Tesla how many cars they could make, how could they manufacture 5,000 cars a week and all this stuff. And this quarter, I think they're now saying they did about 88,000 cars or something, which is just huge. So once they report that officially, I think that's going to be a big boost for their stock. And they actually figured out how to do their manufacturing, so they're really rocking and rolling. But that's a company where this quarterly announcement is going to be a big thing. Most companies, not that much. One that'll probably be big at the end of the year, and then reporting in the first quarter, will be probably like Amazon. Well, all of the retail companies. What does Macy's do? What does Walmart do? But really, I think this year you're going to see Amazon's just going to, be far ahead of everybody else. A lot of these bricks and mortar ones are just going away. So you have to have records for every transaction, right? And that's the easy part in many cases. And then you usually staple those records to the transaction document stuff, so you have them all together. Especially if you're going to be audited, which everybody should act like you are going to be audited, right? So bookkeeping is about recording transactions as journal entries of debits and credits and posting them to the general ledger. So that's what we'll look at more now. So it's really all about collecting information. And think about, these companies, it's a lot of information, Google has 1 to 2 trillion searches. Oh my gosh. Coke, 650 billion servings a year. Wow. Walmart, 10 billion customer visits a year. So you think about that. Think about all those, with 5 properties, right? That's a lot, but think about all these kind of transactions, and so you really have to have it as automated as possible. And so that's another thing, point of sale systems, what they call POS. You go into all the restaurants nowadays, and nobody just has an order thing anymore where you take a menu. Some places do, and then a cash register, right? It's all on a screen that takes the order back to the kitchen and then has everything aggregated up. I went to a ice cream parlor in New York in June, and they took no cash. It was a cashless place. Have you heard of that, Chris?
Well, not an ice cream parlor, but I was.
No, but any kind of stuff.
It was a brew pub, but in Seattle, and it was the same thing, absolutely no cash.
A brew pub, no cash? Yeah.
Everything was
Crazy.
Yeah.
Yeah, it used to be you go to a bar, you put your 20 on the table, right? And give some for the tips and all that. None of that
It was kind
anymore.
of nice in some ways because they actually included the tip in it and everything like that, so it was just,
Probably helps with theft too out of the cash drawer.
they didn't.
Well, it definitely helps with
you didn't
theft.
run a tab every time you had a beer, you gave them the card and boom, boom.
You're not a target for theft because you don't have cash.
Yeah.
And you don't have to manage the employees as closely because they can't be pocketing a little bit, because everything is transactional over
Just gotta make sure your inventory's good.
cards and all. Yeah, so I think it's a more seamless way. I bet some people still like to use cash, but most people have a credit card or a debit card or
I opened a store in
Apple
Cottonwood.
Pay or any of that kind of stuff.
I opened a store in Cottonwood 10 years ago, a gift store, and
You did?
yeah,
Huh.
and I had to estimate how much credit card I was gonna use, and so I was like, well, we'll probably do like 10, 20%. Yeah, I didn't know. And we did a huge, I opened up and we did a huge couple months right before Christmas.
Uh-huh.
And they actually stopped, they thought I was doing something fraudulent, and we ended up doing like 75%. There's little kids that could barely hit the counter, and they would give me a card, a debit card, slide down. So it was like 75% was debit card. And
Well, and
it's
that's
crazy.
And that's a better way, even if you're managing your child's, expenses and stuff. Instead of giving them $20, you don't know where they spent it. If you give them a debit card and you can see their account, you know that they spent it on, candy or whatever.
You audit them.
The what?
You audit them.
You audit them. That's right. Okay, it's your audit today, son. So, and these kind of things, even for ourselves, right? They have a lot of these apps now where you can actually look at your own savings and break it down by category and stuff like that. Like this, so for example, how much did you spend on food? And then you can start making, geez, I eat out so if I ate at home, I could save $1,000 a month or something, and those kind of decisions can be really impactful because, when we don't pay attention, our budgets are so leaky, right? We just buy stuff that we don't need or don't think about, and it's like, if we start to think about how to trim it back. Have any of you heard of this? There's a movement called FIRE, F-I-R-E, and it stands for Financial Freedom, Retire Early. And it's a whole movement now of like pulling back your expenses so that you can invest money, similar to the kind of things you're doing, where you invest some money because you want to have assets. And some people put it in the stock market or bond market. Some people put it in the real estate or have a portfolio. We have some in real estate, some in stocks and bonds. And so you're saving and investing, and then that money grows over time. That's the big deal, especially if you do it relatively early and you use time to compound the interest. But yeah, there's a lot of advocates of that kind of stuff. One guy is a guy named Mr. Mustache, Mr. Money Mustache, I think he's called. And he has it's a stupid name, but he has a great blog about all these different hacks to reduce your spending and then how to invest it. And tons of people, he has a blog that millions of people read. And he's been into it lately with Susie Osman. You never hear of her? She's like more of an old school, here's how you do your personal finances and stuff. And his whole idea is, to retire early, and she's coming up and saying, well, you can't do it unless you have $5 million in the bank, say, because you have to be ready for every single contingency that might happen. What if you get hit by a car? What if you get cancer? You have to have all this money so that you can save it. Where, he's been saying, well, it's not really the retire early kind of thing as much as the financial freedom, and then, getting out off of the treadmill of in the rat race by being able to have assets that then start to pay you so you can ultimately live off of that money. And if you can reduce your spending enough, you can actually use the extra money that you're making in the meantime to save, and then hopefully have enough income that you can
So that was another.
live.
That was a book I read when I was young. Was Rich Dad Poor Dad? Did you ever read that?
You know, I never have, but it's that kind of
That's exactly
that's kind of thing, yeah.
what I read.
And it's all about those kind of things, and it's basically about investing.
Right.
You know, there's a guy named Picardy, he's a French economist, and he just came out with a book last year called Capital, and it's all about that the middle class has been sort of a anomaly, and there really isn't such a thing. There's the paupers, and then there's the capitalists, you know, the workers and the capitalists. And money flows to capital much more than it does to workers. And we've been seeing that, right? Employment is down to a record, you know, unemployment is like under 4%, 3.7, the numbers just came out, it's unbelievable. And those numbers, depending on how you measure them, but wages have not gone up. And usually in the past, if the labor market is that tight, wages start to get up. Now we've just seen Amazon just did, right? They just raised their minimum wage to $15 because here we're coming on the Christmas season, and they've got to recruit a whole bunch of seasonal employees, and so they're making it attractive. And it also ups the ante. It's a great competitive move too, right? Because now, okay, Walmart, you know, or Costco or whatever, we're paying this amount. Your best employees, you know, will migrate over to us unless you do that as well. And then can you afford to raise your expenses that much, because that's going to squeeze your bottom line, right? So it's an interesting move on many levels that Amazon's doing.
I've always heard Costco pays their employees pretty.
Yeah.
Costco has been known to pay it, but I don't think it's $15 for their minimum wage. But they are known to pay their employees well. And I'm surprised Costco has actually somehow avoided the impact of Walmart of Amazon. For some reason, they are sort of insulated so far.
Don't they do? There's other benefits. I've heard. That's what I've heard. But they have to do something else, because you're right. They haven't gotten that scrutiny.
Yeah, they haven't been squeezed in that way, and I don't get it. I mean, we belong to it. My wife really likes Costco and all, but you pay like $50 or something like that, and then you get to go in a warehouse and buy giant things of whatever, and you know, it doesn't seem like, you know, wait a minute, I'm paying you to shop at your place, and it's like, you know, low, you know, there's not a lot of frills and stuff like that, and you get good prices, but then it's really like using your family or whatever like an enterprise. Like, okay, store that, you know, 85 rolls of toilet paper in the garage, and, you know, 17 pounds of nutmeg under, you know, that'll last us for the next 5 years, but we're getting a good deal on it. You know, it's like, you got to be crazy. It's kind of a kooky way to think, and you see people rolling out with.
Amazon Prime, though.
Well, with Amazon Prime, you get free delivery, but you don't have to buy giant bulk of stuff.
Right. But I meant just paying for the privilege of.
Right. And now with Amazon Prime, you get free or some kind of delivery from Whole Foods. So that's brought a lot of people back to Amazon Prime.
But he's right, because in a sense, you know, those people, even though I love that big thing of toilet paper, but we don't have Costco anymore. But for someone that has 6 children, man, that's a godsend. Now that's
well, exactly. If you have a giant family, but if it's just a couple of people, where's the break even? Yeah.
We can't go through enough of anything of theirs
To make it make sense.
To make it work. I mean, I don't buy any food there, because it's just, unless it's something for like a school function.
Right.
Yeah, 85 chicken breasts or something, and well, you know, per chicken breast, it's a really good price, but you got to have a giant. You got to have 2 freezers in your garage, and it's great if you know.
You might buy the freezer at Costco, the extra freezer.
Yeah, when Armageddon comes, but I think a lot of people have taken that mentality of like, okay, we're gonna, you know, really have these low things instead of, you know, the other way is like the Parisians do, where you just go and buy your baguette and your whatever for that day, and you buy your groceries every single day. You don't go and buy for like you're stocking up, you know, for the zombie apocalypse or something, you know, and you're gonna.
So we just switched to $15 an hour for tellers, and it was actually, I knew it was going to happen.
Did you $15 for tellers?
And I knew when that tax cut, when they did the corporate tax cut, that was part of the give you back to the employees, which I thought was cool.
Yeah, it is.
And
I think a lot of companies didn't do that, and they just
But I knew this was going to happen. So what happens is this. So everyone, you know, I think we started at probably 8.25, maybe 10. I don't know what the starting rate for a teller was, but. The backlash, the initial backlash, because then you got this middle manager or someone that's been there for 5 years, and they're making $14.25.
Now, hey, but what about these guys are coming up close to
So you had that initial like, this is messed up. and I knew that was going to happen. And so it was actually just a little turbulence. And we probably lost a couple people, but I will tell you what it did. We're not looking for, our retention is great.
Right.
So we're not, and that's expensive to train those.
Well, when
employees.
when you start thinking about you lose them and then retraining and
Yep.
that type of gap, and you start figuring on those kind of
And
expenses
we can be picky. So it's like,
and keeping good
so we've
people and
got-
getting
now
good
we have
people.
less positions now because people are staying.
Mhm.
So now the manager can grab it and say, well, I've got 10 people now that want this position. I can pick the best one out of
Right.
this and give you $15 an hour. So
Right.
I was kind of like, that was stupid that they did that. Now my burger's gonna go up and stuff, but it actually helped with, probably helped save us money in the end.
Yeah.
For retention and,
Right.
and
And for better employees that are more efficient
Exactly.
and feel better about their job, because one of the problems with managing people too is that people want to work just enough that they don't get fired, and you want to pay them just enough that they don't leave or something, and that kind of that's a pernicious kind of bad way to be. And
Right.
when people feel good and they're making good money,
Yeah.
and then they feel good about what they're doing, they'll go the extra mile.
Yeah.
And if they don't, motivation is easy, right? You get rid of the people that aren't motivated,
Yeah.
and you get the ones that are. And
but there's a little bit of like right when you do it, it's there was some turbulence.
yeah, and I'm not surprised. And that's been the thing. But on the other hand, having companies that are paying their employees $8, $9 an hour, and that's not a living wage, and they're working like 40 hours a week and just not making enough money to support their family, and then they can get food stamps and they can get Medicaid. Basically, what we're doing is the tax dollars are subsidizing those companies, and that's not right. They should be able. They need to pay a living wage so that we're not subsidizing McDonald's to pay $8 and they'll get their other stuff off of the government. That's not right. That's not competitive. That's not. These companies should have to be mandated to give them health care and give them enough that they, you can have rent and food and stuff like that. Otherwise, it's an unfair advantage that they're having. So you want to make what gets measured gets managed. If you want to make decisions about changing your behavior, and this is the same for companies, right? I just wanted to say sort of what is for us. So this is a whole bunch of words, but I'll get through it. So they talk about the books, right? You talk about the books in a company, cooking the books or having two sets of books. But what they mean by books is the general ledger. And the general ledger is the chart. It's all the accounts that you have that run your company, right? So you have your asset accounts, your liability accounts, your equity accounts, your sales accounts, like your revenue accounts, your expense accounts. And those are the general categories, right? The ones on the balance sheet accounts and income statement accounts. That's basically all the accounts you have. And so those get set up in a chart of accounts. You have your vendor list, which is all the vendors that you have. And each one is an account, and only the transactions that have to do with that particular account go in there, with that vendor or with that type of thing. So you would have 5 vendor accounts or whatever for your different properties or your different rental streams, and each one of them would have an expense account, associated with them and all. And each one is sort of treated like a different division or unit of a company or something, right? Yeah, so if you had your office rent payments, right, you call it landlord or office rent or something like that, and then that would be you wouldn't put your utility bills in there, whatever. All those things are separated out into different, your different expenses. So you have a chart of accounts which classifies the groupings, and then that list of accounts are used in the general ledger. And the vendor list shows the information about the people you do business with, all the, your banks, people you buy stuff from, all that. Your vendor list would be like your handyman and stuff like that, and your mortgage too. So that's basically how it's put together. But when you're working for a company, you're rarely going to put a chart of accounts and a vendor list together from scratch, right? You're going to come into the company, you're going to say, here's our chart of accounts, here's our vendor list, because it's been the stuff that they've been using for the last 5 years or something, and then you'll just know. Then if you start doing business with a new entity or something, you'd add those to the vendor list and make a new account. And so you may have to do something like that where you'd add an account or something. When you started working in accounts, did you start it from scratch or did you pick it up from somebody? Or?
I picked it up from
Yeah.
somebody, yeah.
So you inherited one, and there's probably some accounts in there that aren't used anymore, and you're like, what the heck is that one for, and that kind of stuff.
Yeah.
And you can clean some of those out. Sometimes it's good to do.
So that's why I think this is hard. I'm setting that one up from scratch. You're right. Most of the times you get handed something and kind of a
Yeah.
process, because you said that gal helped you through the process for a year.
Yeah.
Right.
So setting this one up from scratch, I'm still kind of like trying to figure it out and
Right.
how to delete things and.
Somebody set it up from scratch, but and you can get with your accountant or a bookkeeper or something to say, help me set up my chart of accounts, and then you're off and running, and they can say, oh, this is the best way to do it, and all. And you're an hour with your accountant might do
That's
that
true.
too.
Yep.
Yeah, so you might have somebody to
Help out.
look it over and
Right.
things like that. Make sure it's good. But even after you go through it, your first year going with your tax accountant and stuff, then you know what, you should do this, you should do
Yeah.
that. Okay, little by little,
Right.
1 year you'll
You
probably
just
get
gotta
all
start
clear.
doing it, I think.
That's really the thing.
Yeah.
Just start doing it and then be ready to adjust. And you've been doing the properties for a long time, so you kind of know basically what comes in and what goes
Right.
out. It's
Exactly.
not. So the accounting cycle, they call it, that's the sequence of activities that occur in the accounting process. And we'll talk about that now, right? From the occurrence of a transaction through generating financial statements. There's like 12 steps that you do in every single, it's like a checklist. So you don't miss a step, you don't mess up. And the occurrence of a transaction, remember we talked about the matching principle. That's what we consider a transaction where you have a revenue and some sort of expense at the same time. So the first thing is the recognition of an event as a transaction. And so you have, you identify the source, you have some kind of a document, right? A receipt or a bill or an invoice or a check, something that says something's happened, right? And then you decide what the heck is that thing, right? So that next step is analysis. What the transaction, which accounts is it going to affect? So if it's an invoice from your landlord, and okay, now we got to pay rent. That's going to affect cash. We're going to reduce cash, and we're going to the expense will be the landlord, right? So then you have your journal entries, and the journal entries is where the transaction is actually recorded as a debit and credit. And a transaction can have more than one debit or credit, right? It can be, say if it was you bought a truck and you paid for half of it with cash and half of it with a loan, then it would affect 3 accounts, right? One would be the asset, and one would be your cash account, and one would be creating a liability, a loan account. So it can be more than one, but the credits have to equal the debits. So then you make that account, you post it to the ledger, and that's that thing. The T accounts are basically the general ledger where you say, here's the debits, and here are the credits on the account. And then from there you make a trial balance, right? And that's a balance of all the accounts. That's when you generate your financial statements for the first time, and see if they're balancing. And then you make some adjusting entries after that for accrued items, for your accounts payable, your depreciation, those kind of things. The operations section of the cash flow thing, right? The ones that are non-cash payments, where now you have to add your depreciation, now you have to increase, this or that. And then that's called the adjusted trial balance. And from there, you prepare financial statements. And in QuickBooks or something does a lot of these steps. These steps are sort of like even old school if you were doing it by hand, with writing them in a ledger book or something.
I was thinking of Ebenezer Scrooge.
That's what I always think of, is Ebenezer Scrooge and Bob Cratchit, sitting at those tables. But that's how people used to do it,
Well, in your
And
book you said you had to be pretty freaking smart, and I agree with
you
that.
did, yeah.
I have big spreadsheets, and they still get messed up, and that's a spreadsheet calculated, and I can't imagine doing it by hand.
By hand, and then trying to find where the mistakes are made and stuff,
God.
or where you might have transposed a number, all those kind of things. It gets. But with QuickBooks, it's almost foolproof in a way, and you make a lot of mistakes. But not like it was back in the
I
day.
don't
You
remember
know?
the Ebenezer screws. That makes perfect
Yeah, I
sense.
mean, if you enter anything Perl, I'll be like,
Yeah.
whoops, I did something wrong.
Is that what
Mine makes like
a sound?
yeah, which is always
Wrong.
nice, yeah, idiot.
We've got all those old. We have old bank books. Like we have a lot of these old branches, and you just go in that like where they're stored, and you just find these old books just full of all that.
Ledger, but well, back from the '60s or '70s or '80s, it was all done that way. And
Yeah.
and then there was one of the big things was just calculators where you could do this kind of stuff, right? Remember
Mhm.
those where you do it by hand and all?
They have, like,
There's
an abacus.
well, an abacus was a
And tellers,
very
like,
old.
Back in the day, had those things at their teller station.
Yeah, no, absolutely. That was a simple way to do. In fact, there was like races back in the day, like John Henry and the, trying to beat the automated railroad machine. It's like abacus guys versus computers and calculators and stuff, and they could do it just as fast. Yeah, because that has 5. It counts in different. And slide rules were the other thing we were calculating. Then when calculators came along, it really made it so much easier. But then we atrophied our ability to even guesstimate the range of a number. And if it comes out on the calculator, well, then we say that's right, even without thinking, wait a minute, is it tens or hundreds or thousands? How big should it be? Or, during World War II, they did a lot of efficiency things for like bombing raids and stuff, and they didn't have computers. They had human computers. They'd have rooms of people with those adding machines with the cranks on them, and each one of them would take a process in the calculation.
That's great.
Yeah, and that's how they did it, and they'd have hundreds of people, doing this all day, calculating these things that now can be done really fast with a computer.
Wow.
But in college, this was with me. For my college, I learned how to make all of these financial statements by hand, like writing,
Wow.
like all of that, like 4 years.
Wow. That makes it better as far as you understand how they're put together. And that's really important because when you're just putting in the numbers and all and you don't really know how it goes, it's really good. But it's nice not to have to be able to do that.
Well, I
right?
remember all the T accounts, doing all those things where you had to make
Yeah.
a T account and
Make
we
a T
wondered why
account,
you
put the
did it.
debits and credits, and
Like
that's
you
what it
said,
was.
because
Yeah.
you need to know what QuickBooks is doing behind the scene.
Yeah.
That's so true, because when I started my job, it was like I couldn't see the forest through the trees, because it was just, you would be learning these little pieces.
Right, and how do they-
but I
what's the
couldn't see how
context?
it
Yeah, all fit
came
together.
For a while, and then, now I get it.
I think that's the problem with accounting. I think the way it's taught is sort of backwards, where you start with the debits and credits and the T accounts, and it's like, what am I doing? Instead of like, you're making financial statements, and then these are the parts of it and stuff, and then
Well,
and
didn't
you
that's
kind
you
of
say you told us, that's why, and it resonated with me, you said that you're talking to some people with MBAs, you're like, well, what's the financial statements? And they're like, I don't know, but they could tell you.
They're clueless.
Yeah, clueless. So
Yeah.
you learn these silos through school, but
Right.
you don't realize you can't put them together in
Right.
a full picture.
and synthesize them, and that's what you ultimately have to be able to do.
And this is making a lot more sense now. I wish I would have known this because I did this 16 years ago, and I wish I would have. It makes so much more sense because I've done it now in a corporation. So it's like, God, this is so much. It's refreshing to see this because I didn't understand it. I was just doing the motions to get the degree, obviously. So it's nice, yeah.
Excellent. No, that's so then you make the financial statements, right? And then you close that out. The one thing to think about with this is the income statement, right? The revenues and expenses, those accounts, those are what we call temporary accounts. They don't after you make a new balance sheet for a particular time period, they're basically closing out and re-zeroing all those revenue and expense accounts, right? So yeah, so like we talked about, just to make it small, a balance sheet, right? And then an income statement, and that's over that amount of time with the revenues, expenses, and the net income. And then you have another balance sheet over here, right? And then there's the cash flow down here, and you have ops and investing and finance. And so this might be money going out to buy stuff. This is money coming in if you get a loan or sell stock or something. And this is the add backs and takeaways from depreciation and accounts receivable changes and all that in operations. And then here you have your cash, right? And so that cash then comes up here to add it to this cash here, and that's your new cash balance, right? And then the net income, you might do some as a dividend out to the owners or something, but if you don't, the rest of it or whatever is left over goes into retained earnings, right? It goes over in here in your equity section, right? And then here's your liabilities and here's your assets. So the net income comes over there. So you can kind of think of the income statement as residing in the inside of the equity part of the balance sheet, right? It's really, revenue minus expenses equals net income is kind of a bunch of accounts that reside in retained earnings, sort of is what you can think. And here's your liabilities and here's your assets. Well, once you do these calculations and all right, then these accounts get zeroed out again, and you start for the next time period, whether it's a year or a quarter or whatever it is. And so these go away. These are permanent accounts. The assets, the liabilities, and what happened in this time period is reflected in the retained earnings.
I can't remember what you always had as of. There was always like an as of date. Is that the net income, or the here is this, or is that the snapshot?
Well, usually, you'd have the balance sheet as of a day. Yeah.
It's a snapshot, right? It's a single snapshot.
It's a single snapshot of just one day. Yeah. So usually you have one at the beginning of a period. I'm just going to say beginning of the year and end of the period, right? End of year. Right. So it'll be it would be as of December 31st, okay. 2018.
But it was the balance statement you're saying.
Balance sheet.
When you say okay.
Yeah. This will say for
2018.
For the from June 1st to whatever okay. Kind of thing. Yeah. It has to be over a certain period, and this has to be on a specific date.
Okay.
Right. So this would say as of.
Okay.
So the closing entries close out all these accounts, right? Now you're saying, okay, it looks good, everything's balancing, we did the adjusting entries, it's all good. And then afterwards you do a post-closing balance just to make sure everything's good. So that's the checklist that you go through every time for every cycle. Make sense? So we'll go through, So here, the good news is that your software will take care of a lot of this kind of stuff. And then you just want to try to fix your mistakes when you make them. They're getting much more automated, though. You really can get more if you have a point of sale system. I mean, if you have something like Stripe, where people are going onto your website, doing their transactions, all that stuff can go right into the revenue kind of things and populate it up right away. And any kind of expenses can be automated out. And you can pretty much in bigger businesses automate a lot of the accounting. So you don't actually have to have people manually put in the transactions anymore. So this is just a really good way to, so you get accuracy and conformity. We don't have as many errors anymore, but it's a detailed-oriented activity.
I think sometimes it can even be confusing, like which account to post it to.
Yeah.
I mean, and then that's when sometimes, the discussion with your accountant comes, well, I thought I should be posting it in this, but because it can get, depending on how you view it and
right.
It.
And how do you split it up right and all that kind of stuff? Yeah, absolutely. Yeah, and that's the examination part of it, is which accounts does this impact? So at the analysis part, that's the second. Once you recognize, okay, we got an invoice or something, what accounts does this impact? That's the second step, and that's hard sometimes. And if you do it wrong, then you maybe got to back it out and put it into another account and stuff like that. Yeah, so it's good to have those conversations up front. Like carpenters say, right? Measure twice, cut once, kind of thing, though. So there's a process to how the transactions are entered. Like we said, through an invoice or bill or something, they're entered as obligations, either a payable, a receivable, cash disbursement, revenues. Either you receive money, right, or you pay money as expenses, or you're owed money, an accounts receivable, right, or you're obligated to pay money, an accounts payable. That's basically the accounts you're going to have, right? Those kind of four accounts are the only accounts you're really going to have. And really, these two accounts, your owed money or you're obligated to pay, are just sort of sub-accounts of revenue and expenses, right? This is an expense, and accounts receivable is a revenue. It's just you haven't gotten it yet. You're owed it, right? It's an IOU kind of thing. And these are the two accounts that are generated by accrual accounting.
So I guess a deposit on a house would be account payable, even though, because you still would owe that. Technically, they can get it back at the end.
Oh, deposit, yeah, if they give a deposit on rent, yeah, right. That's an account payable. That's a liability. You have that, and they get that back, or you'll net out something,
Right.
you know, at the time when you find out that they torched the walls or something. So each transaction is done as a journal entry, and it's double, you know, each entry has two accounts. You're increasing one and reducing another, right? And they have to balance. And that's called double entry bookkeeping. And there's two entries, a debit and a credit. And like we talked about, it can impact more than just two accounts. But the credits have to equal the debits. And then all journal entries are posted to the general ledger. And that gets posted automatically in QuickBooks or something like that. You just do the journal entry, and then the general ledger, it'll flow right through to that. But it used to be that all that stuff had to be done, you know, marched along by hand. And then the financial statements are the summation of all those entries. So now this part is something that gets people really confused, and I'm going to try to make this really clear. Debits and credits, right? They're the most basic terms to become familiar with, but they just mean, you know, raising one account and lowering another. They represent a fundamental concept of it, and they're the fundamental parts of double entry bookkeeping. But it takes some time to get used to, and don't worry about if you don't get it right away. It takes some time. But let's talk about that now. So in balance sheet accounts, you have a balance sheet, right? And in a way, debits and credits, the T accounts, are kind of like a mini of the balance sheet, right? Yeah, on both sides. So asset accounts, and I'll send you a cheat sheet. I got this cheat sheet of what increases what and stuff like that, so you can always learn. But it's not that difficult. If you just get one right, then you know the other side's the opposite, and then it really makes sense. If you can just remember, I would say try to remember that debits increase asset accounts, and credits decrease an asset account, right? So asset accounts usually keep a debit balance, right? You want to have a positive cash, money in the bank, right? So it would be a debit balance, and all of your assets will have a debit balance. Now, when you think about like a piece of equipment, right? You might have, say you have a truck, and the truck costs 10 grand. Well, that's a debit balance, right, of $10,000. You have an asset $10,000. But then you take, say, $2,000 worth of depreciation. Depreciation then is what? It's kind of a credit balance account. It's called a contra account because it's a contra to the, you know, you're netting that out to make 8 grand, right? So these are asset accounts that have credit balances, so they're called contra accounts. Kind of makes sense?
Yeah, been a while.
But all of these are going to have debit balances, and so when you reduce cash, say if you pay a bill and you reduce cash, what would that do to cash? Would that credit cash or debit cash?
Debit.
If you're
Sure.
taking cash out, you pay a bill. You pay $800 to your
Oh,
landlord.
the debit increases, it's an asset still, right? Your cash.
Right. So you would credit whatever that thing would be. Credit $800. Credit cash $800, right? And debit whatever account, you know, on this
What's
side.
on the other
goes
side? So
away.
you have a credit of 800. What's on the other side of your account?
A debit.
Of 800?
Say that it was an accounts payable, right? It was in AP,
Yeah.
It was accounts payable. You had to pay, somebody came and painted your place and it cost $800. And you put the bill into accounts payable and now you're going to pay it, right? You're going to pay the bill. You're going to
$800 to come on that side.
you're going to credit cash $800 and you're going to debit that account $800.
Okay.
And so that's the other thing now on the liability side, right? On the liability side, liability accounts have usually credit balances. They have the opposite, right? So debiting a liability account reduces the liability account, where debiting an asset account increases that account.
Yeah.
So it would be like, credit $800 cash, debit Joe's painting and supplies or whatever it is. And that would be one of your vendors'
Right.
accounts. Right, so you have to have one on both sides of that. And it could be too, you could get into more accounts. Say that the painter did it, but you bought the paint and you paid him $600 and then it was $200 from the paint store. You would credit cash $800 and debit Joe's paint $600 and, whatever paint store $200, and the $200 and the $600 equal debits of $800. Don't worry about this too much, but see how here you got credit balances increase on this side. And the same thing for equity. Equity would be increased by credits. Same thing, here's the liability accounts, and your equity accounts too will usually have credit balances. And these all have debit balances. So when you reduce these guys, you're reducing them by crediting assets. You reduce liabilities and equity by debiting them. So because the income statement is kind of buried on this side of the balance sheet, it works the same way, right? Revenue accounts, right? Revenues are sales, right? Money coming in. What's that going to have? That's going to have a credit balance, right? Credit increases revenue. And expenses are going to what? Expenses are going to have, they're taken away, so they're going to be debits are going to increase expenses. So just like this one, we debited, this was kind of an expense, right? This $800 in painting fees was a debit because it reduced that side. It was an expense. So this is kind of the cheat sheet here. I'll send you this too, this
Yep.
slide deck.
I think it only can help when you're thinking of like what account it pertains to, because otherwise.
Well, but then you can start to think. You can say, okay, whatever the account is it an asset account?
Right.
Is it a liability account?
Right.
And those are pretty much the two you're going to use. And then is it a revenue account or is it an expense account?
Right.
Those two are, sub accounts of the liability side.
Right.
So any of your expense accounts are going to have a debit balance, pretty much, right? As you increase them, and your revenue when that comes in, you're going to make credits on that side.
Yeah, when does it go?
What would you do? Say if you got revenue. Say if you got $500 in a sale, and it was cash, right? What would you do? You'd credit $500 revenue, and you debit cash $500, right?
When do you get a debit on revenue? Like, give me an example if you can.
Maybe bad accounts receivable or something, or you probably wouldn't. You don't get too many of them, or maybe returns. Returns might be a debit to revenue.
Okay.
If somebody returns something, you got to give them the money back.
Yeah. So let's say it's $10. So you go $10 on your left, and then you put $10 on expense. You credit that back because you have to take it back out of it.
Well, where would you credit it though?
Back into your assets. Yep.
Cash.
That's right.
Right? You debit this and reduce revenue by $10, and then you credit cash by $10 because you're reducing cash because your cash account's going down by $10. If it was a deadbeat accounts receivable, you'd debit revenue and then you'd credit accounts receivable that they didn't pay.
Okay.
So you'd reduce your accounts receivable by
I think
that
it was
much.
a write-off from the expense.
Right.
Yeah.
It's like they took off for Sao Paulo and didn't pay the bill.
Yeah.
Rack it up.
Right. So you can think about, you'll know any account if you just think about it this way. Is it an asset account, or is it a revenue account, or is it an expense account, or is it a liability, Like, is it an accounts payable? You know, those are the biggest usual liabilities that you have with accounts payable. Ones where you got in the invoice and you know you have to pay X amount to whatever. You put that in as a transaction. It goes to accounts payable and whatever the other account is for that account payable. And then when you actually pay it, you take it out of accounts payable and out of cash. So it's an easy way to think about your chart of accounts should be broken up by asset accounts, liability accounts, revenue accounts, expense accounts. And usually you give them each like a 100 series number, right? All your asset accounts starts with 100 and all your liability accounts start with 200 or something like that. So.
It could be weird. I always think, because I see it all, kind of.
Mm-hmm.
And so when you do the accounts receivable, the accounts payable, but like, a lot of these companies that we do work for, and, there's one person in accounts payable, and then it's got to go through.
Right. They got a receivables person.
4 or 5 other people before that check can
Gets a
even be
check.
cut.
Check.
And so, so I can get something in and it's out the same day.
Right.
It's just so interesting because I think that would almost create more of that stuck in the forest.
Well, absolutely.
That's
If you're
corporate.
if you're an accounts receivable bookkeeper or something like that, you don't know what's going on in the other accounts. You have no clue. Yeah, and I think that would be a really good thing for any large accounting, department, is to train everybody on just so they know what other people are doing. In case somebody gets sick, you can take over and do the other stuff, or at least understand where you fit in the grander scheme of things. Yeah, because people get so siloed and far other trees. Yeah.
Well, you just named exactly how we cut checks. What she just said is exactly how we do it. It's one accounts payable person, and then there's 5 people on a PR. So if you want to cut
All these
anything
approvals,
over
yeah.
$2,500, it's like 5 people.
Yeah.
And it goes through different departments, and then like the guy that's running, the lead guy finally signs off on it.
Right.
And then you get your check.
Right.
And-
It's just.
And part of it, that not just to make it Byzantine and inefficient, but fraud controls too, that it's just not one person. Because when you have one person that's actually doing it all, opening the mail, saying where the accounts are going to go, cutting the checks, it makes for, there's no separation of duties, and so it's more potential for fraud.
What's interesting what you said is the numbers, because we have those numbers. I'm going to start paying attention to those, because we did like control budget numbers, 107 this. I think 402 is our asset numbers for fixed assets.
So you would know maybe the 400 series might be something, and 300 series is something else. So yeah, and if you get the chart of accounts, then you could know, these are all in that kind
I
of
just said
order.
their numbers, but you're right, they lead to accounts. It's interesting.
Yeah, and usually they, if you're a bigger company, you might have 4-digit numbers instead of 3-digit numbers, because you might have more than 1,000 asset accounts.
Big ones.
Yeah.
Or big banks.
Right, so you might have 5 or 6-digit numbers, something like that, or it may not be numbers, it might be something else. But yeah.
Cool. I'll look for that.
But yeah, if you look at the chart of accounts, you'll see they usually have some sort of they're grouped in this way, because you're not going to have one liability over here and another account, somewhere, all the liabilities will be sort of sequenced, all the assets will be sequenced, and they might be out of sequence a little bit because you had a chart of accounts that now we don't do business with these people anymore, or that asset went away or something like that, and so that there'll be some leaps in the numbers maybe, but for the most part it should be pretty sequential. Oh, good. Yeah, check that out and see.
Yeah. No, I'm going to. It makes sense now. You just see his numbers here, but it's cool. Yeah. That's what they're doing.
So this is just more about debits and credits and how they're going to impact these things. You go to the deli, you get the sandwich, the deli gets the money, and each side has two sides, right? Your cash account gets credited, it gets depleted, but you get this asset of the sandwich. It might be a temporary asset because it's going to be gone in a half hour, right? But it's the asset that you have. And then what is the deli gets the money and debits their cash and credits their supplies or cost of goods sold kind of thing, right? So each side has two different accounts. And each one will be a mirror image of the other. This is actually something where accounting is a zero-sum a zero-sum kind of thing. What happens to one group happens exactly the opposite to the other. So again, these are tricky concepts, but if you just think about them a little bit until your brain hurts and then stop, and don't think that you have to, learn it all at once, or even if you're just generally familiar with these concepts now, that's really all you need to know.
Cheat sheet's what you need.
The cheat sheet, yeah. Just a little cheat sheet. And I have one, I'll email it to you, and that one on there where it just says, that basically asset accounts have debit balances, liability have credit balances. If you just think that, you're fine.
Or you just go to QuickBooks. Like I said.
Yeah, and if it doesn't balance, flip them, and hopefully it does. Because it does all the math for you. Believe me, I've done that many times. It's like, oh, I'm too tired to try to
Do
think
they
this
actually have
through.
like a button that's like flip, and you just like hit the little...
They should. I don't think they do. You have to actually back it out and change them.
Just flip it. Hey,
Flip
worked.
it. They should have that button.
There you go, guys.
They might have that now. If they don't, they should. You should tell them.
I never like when my accountant's like, "Laura, can I see this again? Like, let's sit down." And I get all hot and like.
Right. So yeah. Well, it's a lot of anxiety, because it's a lot of brain work, But if you just know it a little bit and rely on somebody who does, and then you just walk through it with them, you can think it.
QuickBooks was superior because I don't know if the stuff I'm using with these rentals. QuickBooks talked to your bank account, and that was huge.
Yeah.
'Cause you can do it to the dime, and it's like,
Yep.
oh hey, where did this? Oh, that's a fee, $2 fee, but if you don't catch it, you're really not capturing your books to see. But QuickBooks was
Exactly.
awesome. Like you synced it, hit
Right.
it, and came back, and like you have everything on there, and it's like that's what this.
And that's what you want to do is you want to reconcile these
It's so
accounts
much
to
easier.
the bank
I
account.
know.
That's really critical. Yeah.
Yep.
So these are just different examples, right? You pay a bill, you credit cash, right? It's an asset account, you're reducing the amount of cash. Take out a loan, credit the loan account, and you debit cash because it's coming in as cash, right? And you'll refer back to this a lot. Don't worry about it. It becomes clear with use. And even if you just know a little bit about it. This is all about the history of double entry accounting. It basically started in the 1400s. I mean, it's been around for a long time, right? Which is really remarkable. And it was a really big invention that really changed, created a ton of economic development. I mean, it's arguably started the Renaissance and took us out of the Dark Ages. It actually allowed us to do capitalism and get modern history, So here I say that it's a workaround for, we didn't know zero in the West, and so those balancing of the two accounts sort of created like a zero, but it's actually more than that. So that's not, I'm not sure if I really stand by that statement anymore. But it's kind of an interesting concept. So we've talked about accrual and cash accounting, right? And we know that accrual accounting is where you're doing that matching principle, matching a revenues with an expense, no matter whether you got the money in or you actually paid the bill at that time. And that's why we get accounts receivable and accounts payable as well. And that's why we need a cash flow statement to reconcile profit to cash.
Your cash account's a hot dog stand.
Unless it's a complete cash
I like
business.
it. That was a good example.
Right,
I
yeah.
can never understand which business.
Yeah, and then you don't have accounts.
Hot dog stand, yeah.
You don't have accrual unless you say, "Don't worry, Joe, pay me next week
Right.
for that hot dog."
Makes total sense.
People don't do that though.
No.
But sometimes they give you a bar tab or something, and that's a accounts receivable, right?
It just stinks when you pay.
I just don't know if they do that
grocery
anymore.
tab.
What?
I don't think they do that anymore.
No. Well, yeah, because people don't pay
It'd
it.
be pretty cool if they did. Maybe in Wisconsin, like some smaller cities or something like,
If they really know you, they're not
Yeah.
going to do it, because you'll run off and not pay it. Especially if you're drinking, then you're not the most responsible
Pay
person.
gross receipts though, like on the accrual basis, because there can be times you don't ever get paid, and so you've paid tax on it.
Pay tax on stuff that you don't actually,
and
yeah.
You don't actually get.
That's probably
repaid.
good.
That's a good point. That's a
Yeah.
good point.
Yeah, and so you totally get hit, and I know.
Because you pay taxes on accounts receivable.
Right, yeah, and it's.
And then, like you said, you have to collect sometimes people won't pay.
Yeah.
So that's when you have to
months
make
and
that
months
correction
and months
next year.
out they pay.
And that's a good point. I wonder if you can actually advocate for, we overpaid on our taxes because those accounts receivable that were bad debts we didn't get, and we paid taxes on that, so now we want a credit going forward.
Yeah.
Probably can do that with your tax accountant.
I think
It's only fair.
You can amend tax up to like 3 years, I think. 2
Amend
years.
taxes, yeah.
Yeah, you can do an amendment. They can throw this an amendment if something comes up.
Yeah.
Yeah, I don't know, I've just been thinking about that a lot lately.
Yeah, but that's a good point. If you have accounts receivable that aren't collected, when you write those off, the gross receipts tax that you paid on that write-off should become a credit to your next gross receipts bill, to your next gross receipts tax bill.
Yeah. It's made some
You're going to go
money
save the
this
firm big bucks.
class. Laura made some money in this class.
Put that into your bonus.
Right? Yeah. My husband, excuse me.
Yeah.
That'll make for interesting dinner conversation. Some more on accrual, you know. When the cash is collected, then the receivable is cleared out, that's credited, and cash is debited, right? So you have those two, they're both, there's a transaction where it's not a liability and it's two asset accounts, not a liability and asset, right? So you got your cash account and you got your accounts receivable, right? When you have, say, $100 in accounts receivable, when that money actually comes in, what's the T account? You're going to credit, right? This is the credit side. You're going to credit accounts receivable, the $100, and you're going to debit cash, right? $100, because now it came into cash, and the receivable has to go down by the commensurate amount that the cash went up by. And that both of those are on this side of the balance sheet, right? It's not like one is a liability. You're not incurring a liability. Same thing when you buy, say you buy an asset. You're going to be debiting the asset account, right? $10,000 for the truck. If you bought it with cash, you're going to credit the cash account by $10,000.
These guys had a lot of thinking back in the 1400s to come up with this method.
Incredibly ingenious,
Incredible.
really, and allowed for, really good records to be kept, and
Crazy.
it changed everything,
Yeah.
And we're literally doing it the same way to this day. We've computerized it, but the concept is exactly the same. I can't think of anything else really off the top of my head that we still do the same way from the 1400s. Isn't that remarkable? So here I talk about the Khan Academy videos, but we saw those, right? And so those are always good to go over again if you ever, and the matching principle. We've talked about this concept, and that's what makes accounts payable and accounts receivable. And if you ever forget about this, but I remember when I first would hear that, do you do cash accounting or accrual accounting? I have no idea. What does that mean? But really, it just means that you're.
It's one of the first questions QuickBooks will ask you when
Yep.
you're opening it up.
Yep, you're going to make
You're gonna do-
payables and receivable
Yep.
accounts, and have depreciation and amortization. That's basically all it is. And prepaid expenses, things like that.
Prepay is accrual?
Prepaid's an accrual, or it's an asset. You can, you put the prepaid on here, and then you take out, you sort of depreciate it down every time you use it, kind of thing. If you prepaid a year of rent, say, you do 1/12 of that every month or something. So payroll is its own thing. My advice there is hire a payroll company. Do you have a payroll company? Yeah, it's really, first of all, it offloads some of the liability if you mess up with taxes and stuff, and that stuff's really crazy, and it's a lot of really difficult accounting, and to have a payroll company, it's much better to do it that way, much safer to get it done right. Because there's all these things that take out the FICA taxes and the Social Security and, unemployment tax, and getting all those correct. And
All that stuff.
right, exactly. It's just really good to just have a payroll company.
Unless you get one that doesn't do their job right. Well, we had a little problem with that last year.
Oh, did you really? Was it what Paychex, ADP, are the ones usually that people use?
We use Payday.
Payday?
But unfortunately, I just got someone and she was not very good at her job. I mean, every payroll, it was something
Oh, no.
And so it was so frustrating and frustrating. for people.
Did you change vendors, or did you just complain
I
enough that they got
changed
a
it.
different person?
They had it into teams, and so I just changed teams and got someone else, and it's been great
Now
ever
it's
since. But
smooth?
yeah, it was super frustrating because it was just one thing after another.
That's terrible.
I
That's
think
the last thing you
QuickBooks-
want.
QuickBooks had that offered. I think it's ADP through QuickBooks.
Well,
Sounds
when I
good.
had a company, we actually used QuickBooks and did it ourselves, but it was just too.
No, I think QuickBooks offered it. I'm pretty sure.
And
I
it, the
remember Wells
QuickBooks,
Fargo actually
QuickBooks
did not
offers
offer
it, and you can download the tax tables every year, and they update them and all. But and then you get checks that have three with two receipts and the check on it, so you keep one. But
That's why I did.
better
use
to
it.
have somebody else
I
do
didn't
it.
use it because you're right. And I looked at that. And I didn't do it. I just paid for
Much
it.
rather pay.
Oh, it was so worth it. And I was a small business. I didn't have a lot of.
It is worth it.
Yeah.
So yeah, payroll service outsource the whole thing. So let me go to fraud prevention. What time is it?
7:40.
You have to go? Oh yeah, go. We're gonna end here. We're gonna end on fraud. Save some
Oh
for
man, that's the best one.
for next
You're
time.
gonna teach us how to get away with some.
Next class it'll all be how to get away with fraud,
Good.
how to cook the books and
What do you think about that New York Times